Okay.
Hello and welcome to Trading Hour, live from the CNBC-TV18 Motilal Oswal studio. I'm Sonal Bhutra. With me are Hormis Fatakia and Reema Tendulkar. Good morning, guys. It feels like I feel like we're towards the end of the week already. We are, but it feels like a Friday, but not for the bulls for sure. We are at the day's low as we speak. You know, yesterday we were range bound again. In the last hour of trade, we saw Reliance falling and taking the Nifty lower. But for now, if you look at the Nifty levels, we are way below that 25,400 mark as well. It's an 84-point cut on the Nifty that we are witnessing currently, and it is closer to the day's low. The mid-caps are lower, the banking index is also lower, and most of the sectoral movers are in the red right now. So pharma index down 1%. IT has taken it to the chin as well. Remember, we have the earnings starting today itself. TCS is the first one to report numbers. So all these names are in focus. There's been a sharper fall in the mid-cap index in the last couple of minutes itself. We have the CPSE basket, which is not doing so well. So looks like after being in consolidation for a long time, we are seeing some fall from the higher levels. We'll have to see. A lot of things depend on the earnings as well coming forward. And the big US-India trade deal, there has been no word on that.
Indeed. So yesterday the 25,500 mark got taken out. Today the 25,400 mark has been breached on the way down. Benchmark indices are down close to about 0.3%. And as Sonal said, mid-caps have underperformed. So week to date, the mid-cap index is a cut of close to about 0.9%. Individual stocks, at least in the large cap space, Bharti Airtel is your top loser. That's down about nearly 2%. Pharma names, the Nifty Pharma Index is down 1%. Individual constituents like Cipla, Dr. Reddy's, Sun Pharma losing more than 1%. In the IT pack, it's Tech Mahindra and Wipro, the weakest of the lot. TCS, so far at least, is holding on to the flat line. On the way up, Maruti Suzuki, an Axis Bank, so a couple of these private sector financial, Innocent Bank, Ultratech Cement, higher in trade.
All eyes on TCS later this evening, but even the broader markets for that matter, the index has gone lower. The broader markets have not had it any better, and they have been underperformers more often than not over the last few trading sessions. 100 points lower on the mid-cap index, and if you take a look at that from the day's high, it's almost 260-70 point correction from the highs of the day. Metropolis is the top loser on the Nifty 500 today, 4% lower on that stock. Defense stocks are not doing well in today's session. Garden Reach is down 3%. Bharat Dynamics is down 3%. Zen Technologies too is down a similar quantum. Data Patterns is down 2%. So selling across the board seen in a lot of these defense names in today's trading session. On a higher side though, there are names like Acme Solar that's doing well, 7.5% higher on that stock. Campus Activewear has been among the top gainers all through the morning within the broader market, 6% higher on that stock. And the other one is UTI AMC. Just a couple of days ago, Antique had come out with a note on these asset management companies where they had initiated coverage on all four of them, and UTI AMC was one of them, and they had projected close to a 12 to 13% upside on UTI AMC, a 1500 rupee price target there. So 4.5% lower, higher on UTI AMC as well. But some of the other names that have done well are the power financiers in the morning today, and that are PFC and REC. Both of them trading with gains today, and they have gotten an initiation from Morgan Stanley. Remember, they are a consensus buy across the analysts who track the stock, and Morgan Stanley is the latest addition to that list. Gaurav is here with more details on this. Gaurav.
Well, yes, definitely power financiers are in focus, specifically PFC and REC, and the reason being that now Morgan Stanley has initiated a note. For PFC, they have given a target price of 508 rupees, while for REC, they have given a target price of 485 rupees while giving the outperform rating. What they are saying is that the stock has been muted if we compare it with their performance in 2023 and 2024, and if we compare it with that, the stock has been muted for the last 9 months, and from here on what they're expecting is that 12% growth is what we can see in loan book, and at the same time the stock can also give ROEs in the term of 17 to 19% over the next 3 years. Given all these factors, when we look at the valuations now, as per Morgan Stanley, the valuation is still at a cheaper rate, and it still looks attractive given the quality of earnings, and at the same time 3 to 4% of the dividend yield that the company is currently paying. And factoring in all these aspects, the Morgan Stanley has now initiated with overweight rating. Definitely on the back of this, stocks are also buzzing. Both the stocks are up in trade today.
Okay, all right. Thank you so much, Gaurav, for joining us with all those details. The other stock on our radar is IREDA. Tell us more about it. Why is the street excited?
Two reasons for IRIDA. First is that now government has allowed IRIDA to raise funds via 54 EC bonds. Now these are actually capital gains bonds. Let's not forget that using these bonds, company can raise funds at a rate as low as 5.25%. Now these are actually the bonds for tax exemption for investors, and there are this is the sixth company who will be raising the bonds using these this instrument. We have got REC, NHAI, PFC, IRFC and HUDCO who are already using these bonds to raise funds. Now let's also not forget that in FY25 we have already seen that there was some benefit in cost of funds. We have seen IRIDA's cost of fund has gone down almost by 20 basis points, and with this new instrument for fundraising, it seems that there will be another tailwind in terms of cost of funds, and we may also see some uptick in net interest margins. Now there is another trigger for IRIDA is that the results will come for first quarter today, and let's also not forget that in the quarterly provisional updates we have already seen a strong performance from IRIDA, around 32% growth on a year-on-year basis in terms of loan book and around 26% growth in terms of the loan disbursements. So on back of these numbers and specifically the new announcement from government, we are watching out on IRIDA, and as we speak the stock is also up in trade today.
All right, Gaurav, thank you for that update. You know, since we are on the subject of PSUs, the couple of other PSUs that are in focus right now, two of them actually, they came out, some updates came out last evening with regards to them, and both of them, one of them being LIC, the other one being IDBI Bank. Now, LIC for IDBI Bank, of course, sources have told CNBC-TV18 that the long-awaited disinvestment process for IDBI Bank is likely to be completed by October of this year, and that is the latest on the IDBI Bank disinvestment. Now, when it comes to LIC and a lot of these other PSU banks, now the government has given an offer for sale approval for the 5 PSU banks that recently did a QIP also. That OFS could take place later this year. Now, the intention behind this, of course, is for all of these lenders to meet the minimum shareholding norms, and Bank of Maharashtra will meet the minimum shareholding norms via the QIP route, and the other 4 banks will have to do an OFS because the other 4, which is Indian Overseas Bank, UCO Bank, Central Bank and Punjab and Sindh, all of them have a government stake in excess of 90%, and the QIPs that they did recently, that did not result in a very significant dilution. It was just a 1 or 2% dilution. It still remains above 90%. So these public sector banks this year are likely to raise around 45,000 crore rupees through the QIP route, and a majority of that share, of course, will come via the SBI QIP, which is likely to be worth 25,000 crore rupees, and the rest will take place from other lenders. Now, when it comes to LIC, the government has given an approval for an offer for sale, is what sources are telling CNBC-TV18. And the finance minister also mentioned that systemically important NBFCs should aspire to become banks. They need more banks, and they aspire to have at least 2 to 3 large Indian banks among the top 10 global banks within the next 2 decades, which is by 2047. Now, for LIC, the government still holds around 96.5% stake because that 3.5% was the only one that they had divested 3 years ago at the time of the IPO. And even within this public shareholding, which is of 3.5%, most of it lies with mutual funds, and close to almost 20 lakh retail shareholders have the remaining 1.7% stake. So at almost 6 lakh crore rupee market cap, stock trading at 0.9 times price to earnings, every 1% that the government will divest here will help them fetch around 6 lakh crore rupees at the current price. So that's LIC for you. Still trading around about its IPO price of 949. It made a high of around 1200. 1222 is the record high that LIC had made. So it has corrected from those levels, still languishing around the IPO price almost 3 years after its listing.
Thank you very much for that. That's the latest on the monetization by the government that IDBI has been long awaited, right? The flagship privatization of IDBI Bank. Let's see if it happens by October, as we've been picking up. Get into a break. On the other side, the Finance Ministry could be considering about 32 to 35,000 crore rupees fund for oil marketing companies. We'll get you more on this story on the other side. Welcome back. TCS will kick off the first quarter earnings season later today. Numbers are typically out around 3:30, 4 o'clock. There is a press conference scheduled at 5:30 in the evening, and then tomorrow we get chatting with the management. Now, before we get to the numbers, just one thing about the valuation. I was looking at a Goldman Sachs, and they're saying that TCS is the most compelling on valuations versus the company's own trading history. So a Tech Mahindra, HCL Tech, LTI Mindtree, Wipro, Infosys are all trading above the 5-year average in terms of valuation. TCS is the only one trading at par or at a 2% discount to the 5-year average. Again, so on that front, compared just to the recent 5-year, which is the post-COVID average, all the other IT companies, companies are trading at a premium to the 5-year average. If you compare it to the 10-year average also, TCS is trading at a discount of about, a 16% discount to the 5-year average and a 2% discount to the 10-year average. While all the other IT companies, the large cap IT companies, are actually trading at a premium to their own historical averages. So according to Goldman Sachs, valuations for TCS are most compelling, and will that in a way provide some sort of a cushion on the way down? Now getting to the numbers, expect a muted quarter, top line growth declining by 1.5% in constant currency on a quarter-on-quarter basis. Dollar revenue growth will show a growth, but CC revenue is likely to be weak, and that's because the large BSNL contract is slowly ramping down. Wage margins will be flat on a sequential basis. There is no wage hike. Wage hike typically for TCS happens on 1st of April, but the company, citing uncertainty, said that we're going to push it forward. So the street is saying that if there is no wage hike and your low margin BSNL deal is actually coming down, shouldn't your margins have gone up? But that's not playing out. So what will you watch when it comes to TCS? One is growth, because in the last 1 year, growth was driven by this BSNL contract. It was low margin, but it provided the growth. X of that, things have been slow. So that's one. Secondly, pick up in margins. That's going to be very crucial. The third one is timing of the wage hike. Do they now have clarity to provide a wage hike for their employees? And finally, deal wins, because last quarter, deal wins were very strong at $12.2 billion. So an update on that will be watched.
Okay, we'll be watching out for those important things in the results today, and we'll keep coming back to you for that analysis as well, Reema. But moving on, the oil marketing companies, they are in focus. Sources tell CNBC-TV18 that Finance Minister is considering a 32,000 to 35,000 crore fund for OMCs. That is the Finance Ministry. Tim C is joining us with more details on what she's picking up. Tim C.
Well, yes, what government sources are indicating to us is that Finance Ministry is considering 32,000 to 35,000 crore rupees of fund for OMCs. The proposal, Finance Ministry is soon going to take it forward for Cabinet's approval, and this is to help OMCs overcome the under-recovery or the losses that they were facing on LPG. The demand from the Petroleum Ministry was about 40,000 crore rupees of LPG under-recovery funds. And the government feels that this cushion is going to help the OMCs. To be precise, these proceeds, where will this fund come from? Well, this is coming from the proceeds of petroleum excise duty that is being used to compensate the OMCs. And the view behind this proposal that the government has is that the oil companies are part of the same government family. Government does not want OMCs to suffer, and thus a compensation will happen very soon. Let's see how soon Finance Ministry takes this proposal for Cabinet, because the demand was there, and now with sources indicating that the Finance Ministry is considering the demand very seriously, the next move will be that Finance Ministry moves a proposal for Cabinet's nod to help them overcome these losses.
Yes, that's right, MC. Thank you so much for joining us with all those details. The OMC LPG compensation has been ongoing for a while. The expectation was that maybe the budget would give up some relief in form of a subsidy, in form of a grant. That did not come about. And since then, oil marketing companies or the investors of oil marketing companies have been watching out for this big development. So it'll be crucial to track as well. Remember to tune into the all-new CNBC-TV18 Prime, bringing you insights from policymakers, business leaders, and economists shaping both the world and India's future. CNBC-TV18 Prime decodes global shifts and their impact on Indian businesses, giving you unparalleled insights. Tune into CNBC-TV18 Prime at 12 noon for the Global Reset, at 1 p.m. for the Big C, and Global Lens at 8:30 p.m. Welcome back. You're still tuned into Trading Hour. Well, we've been pointing out how Nifty has seen that knock from the highs below the 25,400 mark. It did see a wee bit of recovery from the lows, but let's see which way things go from here on. Apurv Sheth from Samco Securities is joining us for a quick technical check on the markets. Apurv, thank you so much for joining in. Tell us what are the next important levels to watch out for on the Nifty?
Thank you. Good morning, and thank you for inviting me on the show. Now, Nifty is trapped in a range of 25,300 to 25,600. So, until and unless we are in this range, the bias will be on the bullish side. So, buy on dips will be the strategy. I would like to be a buyer on dips to 25,300 levels with a stop loss of small stop loss of 100 points. So, 25,200 is a stop loss, and the target on the higher side is 25,500 and 25,600. So that's on Nifty. And amongst the stock picks, Nippon Asset Management India is looking good on the charts. So I think there was a news about ICICI Pru coming up with its IPO. So all the AMC stocks are in trend. So Nippon Asset Management has formed a cup and handle pattern on two time frames, that is on the weekly and on an intraday time frame, and it is on the verge of a breakout. So the stock looks good for a recent decent rally. The stop loss would be 770 and the target would be 870. And another stock is Balrampur Chini. So the stock is finding good support around the 580 levels. Today's volumes were high compared to yesterday's and the average volumes. So again, Balrampur Chini also looks good on the charts. So one can buy it with a stop loss of 580 and a target of 660.
Okay, all right. Thank you so much, Apurv, for joining in. So those are some technical levels to watch out for on the Nifty and individual technical picks as well. Well, by the way, just let's take a look at individual movers in the broader markets because that index is not doing so well. There's still some of the stocks which are surging as we speak. Glenmark Pharma, for instance, that stock is up 3.5% right now. We have VIP. This is, I think, the third consecutive day that this stock has done well. So that one is up around 3.5%. We have Nuvama Wealth, which is up 3%. That stock had been trending lower in last couple of trading sessions, but it has made a comeback today. We do have something like a Rallis India, PCBL again. So the chemical space continues to be in focus. Watch out for that one. Expected to be a decent quarter, or at least a recovery quarter for chemical names. So PCBL, another day running higher by 2% as we speak. That's about individual names, but let's talk about some notes which are coming in. Brokerage views. Flare writing is gaining in trade. There is a note from Ambit. Ria is joining us with what the brokerage says about this particular stock. Ria.
Well, yes, Ambit has come out with a note on flare writing. They've analyzed the Q4 FY25 results of the writing instrument players, and they've said that domestic growth this time around has been accelerated, but exports have declined. They've also said that the management expects a demand recovery in both domestic and exports going ahead with growth acceleration seen in FY26. Apart from this, they've said that margins this time around have been impacted across the board given the rise in competition and product mix changes as well as some inflation in the raw material. Now, apart from this, they've highlighted that with domestic and own branded sales now at 85% of the total revenue mix and the addition of high growth segments such as creative and steel bottles, Flair's revenue growth has picked up and going forward, sustenance sales will drive re-rating for the stock. They have a buy call on Flair writing and a sell on the competitor DOMS, and as a result of this note, the stock is up over 5% today.
Ria, thanks a lot for that update. Flare writing, an Ambit note coming in there on the stock, 6% higher now, almost 10% up this week and almost 15% higher in the last fortnight. So good going for that company. But the asset management companies are in focus as well. And this is on the back of an ICICI Securities note. I just spoke about UTI AMC, the note from Antique a couple of days ago. And Vamakshi is here with the latest on this ICICI Securities note on these asset managers, Vamakshi.
Well, there's a note from ICICI Securities, like you said. They believe that there is a case
for an increase in AMC multiples, and they have a rationale for this. They say that this could be based on resilient and growing SIP trends. In addition to that, what they also say is that there has been an increased trend of commission rationalization given the kind of growth that they're seeing in their AUMs. Apart from that, they could also possibly benefit from higher consumer discretionary income post the tax cuts as well as the repo rate cuts that we've seen so far. They also believe that there could be a possible push to their growth given that there is a new asset class of MFs, that is the specialized investment fund. They also believe that the most important pointer out here that is driving this rationale is that these companies are facing lower regulatory risks. Now, keep in mind that most of these AMC stocks on an average has surged by almost 34% since the start of FY26. They highlight that despite this, the valuations remain relatively well placed as compared to some of the other capital marketplaces. They believe that all of these AMC companies are better placed on structure valuations within the capital marketplace. And however, increased competition, the competitive intensity in this industry is a key risk. But nevertheless, they appear to be quite positive on all of these AMC stocks.
Thank you very much for that. The stock which catches my attention is Crizac, the new listing. The issue price was $245. Yesterday, stock was up, I think, 25-26%. It's followed it up with another 6-7% move. And an interesting company, right? It's a platform, a tech platform, which will connect education consultants and agents and foreign universities. And I think they've got about 10,000 plus agents in their platform. They file about 7 lakh plus kind of applications. And look at the way the numbers for the company have gone up. I think 850 crore was the revenue last year versus 274 crore 2 years back. So it's a big jump and clearly shows the number of Indians who are, leaving for higher education abroad. So yeah, interesting company, and it's seeing a lot of demand.
Sunil Singhania's Abacus fund was one of the buyers in yesterday's trade at the time the stock listed. So that is another one. They bought stake worth close to around 110 crores, the Abacus asset management firm from Sunil Singhania. So 7% higher on Crizac, building on to its gains that it saw yesterday, ended almost 25% higher compared to its issue price. Yes, 25% higher.
But this is other interesting news. Like, I haven't verified it, but it was in the papers that the US visa, whether you go for tourist, business, H-1B, doesn't matter. They're going to put in an integrity fee of $250. So your traditional fee is about 15,000 rupees on an average, is what they said. So, and you add this $250 and plus a little bit of processing, etc., you come to about 40,000. That said, this integrity fee is refundable.
Oh, okay.
It's a one-time, it's refundable. Basically, what they're trying to prevent is any sort of a misuse. You shouldn't go there and say that, oh, I want to extend my stay.
Got it.
You have to come back within the stipulated. I mean, you get a grace period of 1 month. So if you misuse it and you don't comply with everything, then the $250 fee is held on.
But it is not final. There is no.
No, this is a part of the big, bold, beautiful bill.
Oh, okay. There are a lot of things which are part of the big, bold, beautiful bill.
So
the alliteration is working there, but
just on the point about that student visas, etc., going abroad, this whole trend is just in the near term. There is that short-term, one-time hit.
He's been doing a lot of things when it comes to immigration, when it comes to visas. So let's see what is finalized, so to say, and comes into execution as well. But we'll do one thing. We'll slip into a short break. When we come back, we'll discuss the market fundamentals with Sahil Kapoor from DSP Mutual Fund. Stay tuned for that.
Welcome back. 100 points lower on the index now at the lowest point of the day. 25,380 is where the Nifty currently stands. So continuing this market conversation forward with Sahil Kapoor, who is the market strategist at DSP Mutual Fund, joining in. Sahil, good morning. Thank you for joining in. A lot of the current market over the last couple of years has been propped up by this retail fund flow that has come in from the domestic investors, but foreign foreign fund flows have continued to remain elusive at best, if you could call it that, despite being net sellers all through and through this market correction from September until, say, March or April. Even today, they have not seen a meaningful pickup. What would you attribute that to? And when do you see a reversal happening, if you do see one, that is?
Sure. Good morning. So one thing is clear that foreign investors likely have more choices across the world with better valuations, and possibly they are picking that. And second thing is, a lot of foreign flows which come to India are through the passive route. So for example, if $100 flow towards the passive basket, India has 20-24% share, and they get those, India gets that flow. And over the last few years, emerging market as a whole haven't got a lot of flows. Third thing is that when you look at the emerging market basket as a whole, in the last 15 years, it has underperformed global equities by a very wide margin. It is only post-COVID that we've seen a large recovery in some of the emerging markets. And because of this underperformance of the last 10-15 years, I think the passive flows have also sort of reduced towards this basket. So mix of these reasons has made sure that India gets less flows of that basket coming into the Indian markets. Conversely, India has seen a very divergent performance. So our earnings trajectory has been much more stronger versus the rest of the emerging market. But still, I think we haven't really seen the flows that people would have expected or investors would have envisaged. When will these flows come? I have no clue. I don't have a crystal ball to see. I think we've already delivered over the last 5 years on best equity growth across emerging markets, whether it is in terms of returns or earnings growth CAGR, 20 and 24% respectively. Very stable currency, 4% annualized volatility, higher real returns in terms of debt securities, and still we haven't got the flows that we could have. So this combination is the combination of India doing well on all fronts, plus the global money also flowing towards emerging market. I think that is the important combination. As of now, it hasn't really worked.
But at some point, foreign investors are going to feel they're missing out, because as you rightly said, that despite foreign investors not investing in India because of strong domestic demand, etc., markets have done well. The last 20 years, CAGR, for instance, would be close to about 10-11%. So at some point that FOMO will come in, and it's not that valuations have also corrected. So will that factor, play a part in, foreign investors coming back into the Indian markets? How long, can they stay out of a growing market? And what would be your call on Indian markets per se over the next, say, medium term, 2 to 3 years?
I would say that FOMO-led flows may not be the most appropriate thing to, get for India. And think about this: if you go back to, let's say, the 2007 era or the 2002 to 7 cycle, by the time we hit the global financial crisis, nobody in their wild dreams would have thought that United States will come out to be the best performing market in the next 15, 20 years. And that is what has happened. Since then, about 18 years have passed, and S&P 500 or probably NASDAQ has beaten every other index in the world by a very wide margin. Very few stock indices come close to capturing the returns that they did. Nobody would have thought that it will happen from what the US financial markets went through. So my guess is that the performance of the past may not be the most appropriate way to judge whether these flows will come back or not. My sense is that a large performance uptick, which has happened even in US, has made sure that a lot of money still goes to the American markets. And I think once that outperformance goes out, I don't know why, but the numbers speak for themselves. For example, S&P 500 trades at 25, 26 times. And just about 6-7 years ago, let's say in the Trump 1 era, with very similar earnings growth rate, it was trading at about 18 times, right? So it has also re-rated. So maybe it doesn't do as well as it has done in the next 18 years. That will probably give some amount of a fillip to rest of the markets in terms of, probably flows. And that could be a clincher. Plus, India will have to continue to deliver the earnings growth that it has. And that itself has become a very large challenge. So my guess is that flows will improve possibly because they are more cyclical in nature, and we are sitting at numbers which we haven't seen in 10, 20 years in terms of FDI flows of less than $1 billion in FY25. I think you have to go back to 2003 to see that kind of a data. And FI equity flows have also been very, very tepid. So cyclically, I think they might improve, but you need a number of factors or confluence of factors to see these flows come back.
Okay, while we're talking about factors needed to see the flows come back, right now we're seeing that markets are seeing a further knock from the highs. The Nifty is down around 100 points. We have the mid-caps which are down 166 points. And it is the banking index which is seeing a further cut. So watch out for the markets. We are seeing it coming below the 25,350 mark as well. It's very close to that, not exactly there, but watch out for the next important level as well. So Sahil, when we're talking about our own markets, valuations have been a talking point for the longest time. Now margins are at its peak. So what, according to you, could be the driver of earnings from here on? Do you think that is something that the markets could continue to be cautious about?
So my sense is that we are already sitting at margins which are quite high. When you look at the full universe of the first 500 stocks and look at the profit margins and EBITDA margins, we are close to at lifetime high levels. And the idea is that can margins go up from where they are right now? It's going to be very, very hard. I don't think except United States technology sector, there is any other index or sector in the world collectively operating at margins that we are right now. So it's going to be very hard for margins to go up. So what's left for our PAT or profit growth to go up? What is the key driver? It's the top line growth or sales growth. And sales growth, as you see, which was in high double digit and even exceeding 20% back in FY23 and 24, for the last few quarters has dipped down to single digits. In fact, in FY25, Nifty did a 1% PAT growth and mid and small cap did a 9% PAT growth. And the reason is very, very similar. Even with very high margins, if you don't get top line growth, PAT growth will just match the top line number. So if you get a single digit top line growth of, let's say, 9-10%, PAT growth is going to be 10%, 9%. And if your ROEs are 15-16%, which is what it is for NSE 500 stocks, paying a multiple of 25 to 27 times is going to be challenging. And therefore, it makes sense for you to tone down your return expectations with what we've seen, double-digit 20-25% return post-COVID. I think those are stellar numbers, but the profit growth of 10% and ROEs of 15-60% do not justify for us to pay a multiple of 25 to 27 times. Therefore, it's very important to look for sectors which are cheaper in terms of valuation, doesn't have froth, and second, be conservative about your return expectations.
All right, Sahil, thank you so much. Insightful conversation there. Thank you for sparing time and joining us today ahead of the all-important earnings season that we are on the cusp of. We take a short break here, but the index now 100 points lower as we speak. More on the markets on the other side. Stay tuned.
Welcome back. You're still tuned into Trading Hour on CNBC-TV18. Well, it's a very stock-specific market in terms of brokerage notes which are coming in. Housing finance sector is in focus. There's a Bernstein note. Gaurav is back with us to join us with all the details from that one. Gaurav.
Well, as housing finance companies definitely in focus, and the reason being that Bernstein has now initiated a note on 5 companies. First, let's talk about companies like Home First Finance, Aptus and Aadhar, where they have initiated with outperform rating. For Home First Finance, this remains their preferred pick, and the reason being that what they're saying is company has actually demonstrated ability to consistently replicate its business model successfully across the segments. Other than that, they also believe that the company has strengths like smaller size, faster growth and superior product portfolio, and that is the reason why this remains as their top pick. Other than that, for Aptus, what they're saying is that company has a high share in the fixed loans, and that is the reason in an environment where we are seeing rate cuts, this company is opt to gain. Other than that, Aadhar is also something which is in focus, and the reason being that they say this is the largest and most geographically diversified player, and that is the reason why they have initiated with outperform rating. On the other hand, let's also focus on Aavas and PNB Housing, where they have initiated with market perform rating. For Aavas, they believe that this actually lags peers in terms of yields as well as profitability, and that is the reason they have maintained their market perform rating. And lastly, on PNB Housing, they actually like the smaller ticket size portfolio which they are diversifying. But on the other hand, the transformation, what they're doing, is a little concerning as per Bernstein, and that is the reason they have initiated with market perform rating. As a result, on the back of this note, we are seeing all these stocks are up in trade and buzzing in trade today. So definitely watching out on this space on the back of the note coming up from Bernstein.
Thank you very much for that. On the broader subject of NBFC, Finance Minister Nirmala Sitharaman called on the NBFCs to significantly scale up their role in the financial system. Speaking at an NBFC conclave, Sitharaman said NBFCs are no longer shadow banks, but systemically significant entities. Listen in.
You should aim to reach at least 50% of the total volume disbursed by scheduled commercial banks. Not a big number, considering in the last 4 years, you've doubled. 24 became 48. You can do it even now. So, as India moves forward, NBFCs will have a key role, no doubt, in meeting the credit needs of the future, including in areas like green initiatives, affordable housing, and MSMEs. To reach, and the reach that you have is the biggest strength that you have. By 2047, at least 50% of NBFC credit should be directed towards high growth and high impact sectors. NBFCs, I want to tell you in front of the Department of Financial Services Secretary, you're no longer shadow banks. The stronger regulations and oversight is the best testimony. The stronger regulation and oversight is the best testimony of your importance in the financial system and the broader economy.
You know, the defense stocks, we just spoke about it at the start of the show, the ones that are not doing well in today's session, Bharat Dynamics being one of them. And the stock is in focus because of a Motilal Oswal note. Rhea is here with more details on this. Rhea.
Well, yes, Hormuz, Motilal Oswal has initiated coverage today on Bharat Dynamics with a target price of rupees 1900, which is a 4% downside from yesterday's closing price. Now, the brokerage has noted that BDL's revenues have been impacted in the recent past, largely due to supply chain disruptions and challenges in sourcing critical components, particularly from Russia and Israel. But now these headwinds are beginning to ease out, and they are expecting a sharp recovery going ahead. They're expecting a 35% revenue CAGR over FY25 to FY28. Margins are also seen holding steady in the 24 to 26% range, while operating performance is also set to pick up meaningfully. EBITDA and net profit are expected to grow at an estimated CAGR of 64% and 51% respectively in the same period. Now, the report has also highlighted a strong order visibility going ahead for the company. They have an existing order book of about rupees 22,700 crores and a potential pipeline of rupees 50,000 crores, including large deals like QRSAM and the upcoming defense emergency procurement orders as well. Now, on the macro front, the company is well positioned to benefit from favorable defense sector tailwinds, be it the rising global defense spends, growing exports of the Akash missile systems, or the ongoing collaborations with DRDO. That said, valuations remain a sticking point for the company, currently trading at 70 times the FY26 estimated earnings, which is why they are suggesting waiting for a better entry level for the stock. So on the back of this, the stock has been under selling pressure today, trading around 3.5% lower.
Okay, all right. Thank you so much, Ria, for joining us with all those details. Let's move on now. Viceroy has come out with a report describing Vedanta Resources as a parasite and Vedanta Limited as a dying host. While Vedanta has hit back, stating that the sole objective of Viceroy research report is creating false propaganda. Earlier today, we spoke to Gabrielle, the co-founder at Viceroy Research, and Rakesh Arora, founder of Go India Stocks, to understand more. Let's listen in.
Vedanta Limited, let's say, it doesn't have the capacity to cover the interest costs of Vedanta Resources. So whether that will create an event of default, or whether the possible impairment of billions of dollars of Vedanta Limited's assets will lead the creditors to call that debt, that's anyone's game. We're here to report it, whether we're a bit too early or a bit too late is irrelevant. We've written our research and we think that the end result is a disorderly collapse. We think that, Vedanta Limited has been overly promotional in the ability of its business and the ability of its operating assets, which that have been largely overstated.
Are you done with the report, or will you have more reports coming out on Vedanta?
Oh, we have more.
Unfortunately for Viceroy, they are just 2 years late on this stock. Vedanta Resources already delivered quite a bit from around $9-10 billion to around $4.5-5 billion now. And now servicing that debt is not a challenge at all. Number two is that, Vedanta itself has gone through this whole exercise of demerging, and all the lenders have looked at individual entities on their leverage, on the, whatever the liabilities are. And clearly, they've approved this. So clearly, all the entities are self-sufficient. Otherwise, this kind of approval cannot come from lenders. Vedanta stock is largely dependent on aluminum outlook. And aluminum outlook has been pretty strong and doesn't look to be weakening anytime in future. They are also getting a little bit more of backward integration in form of bauxite mine, coal, their own captive alumina. So things are looking better only for them. So I don't think fundamentally there's any reason that performance would deter. Vedanta has been has done phenomenally well actually in the last 2 to 3 years. Meaning, if you had asked me in 2021, I would not have been able to gauge this kind of turnaround that the management has been able to achieve. And things are only getting better from here.
Okay, let's get into a break. On that note, on the other side, we'll put the spotlight on NVIDIA and its fantastic journey to $4 trillion in market capitalization. Stay tuned.
Welcome back. Let's talk about the big global development, NVIDIA. It has hit the $4 trillion market capitalization number. Hormaz joins us now to take us through the company's stellar rise.
Well, they say bada hai to behtar hai, and a company based 14,500 kilometers away in Santa Clara is justifying that tagline. And how? That is NVIDIA for you. The AI behemoth and Wall Street darling has become the first company to cross $4 trillion in market capitalization on Wednesday. It's taken just over 13 months to add the latest $1 trillion to its value. However, take a look at this rapid rise that NVIDIA has had. It reached its first $1 trillion in May of 2023. In 9 months, it doubled it to $2 trillion. 4 months later, it was at $3 trillion. And had it not been for Donald Trump and his tariff tantrums, who knows, we might have been doing this just a few months earlier itself. Now imagine NVIDIA being a country. At $4 trillion, its GDP will be higher than most countries of the world. In fact, it would be the 5th largest economy globally, behind the US and China, just above Germany and Japan, and followed and just above the Indian economy as well. Now, when I speak about the Trump tariff tantrums in April, they spared no one, and NVIDIA shares also fell to their 52-week low. But the bigger part is that the recovery that the stock has seen, it has nearly doubled from those April 7th lows that it had made. That's just a 3-month window. Now, at $4 trillion, NVIDIA is 73% of the size of the entire Indian stock market, which stands at close to around $5.5 trillion in market cap terms. NVIDIA is the size of 30 HDFC banks, 37 TCSs, and 22 Reliance Industries individually. Now, wealth creation, of course, is the motto to be in the stock market, and NVIDIA has done exactly that. Now, since 2013, NVIDIA has had only 2 negative annual return years in terms of share price. Its 15-year average returns, a cool 70%. Now, take a look at this. Since 2020, NVIDIA has had 4 years where the stock has either doubled or even tripled on an annual basis. This year too, the stock has gained 22% after the plunge that it had taken earlier in the year. But there are challenges that lie ahead. Export curbs still remain to the Chinese markets. Now, founder and CEO Jensen Huang said that these issues have completely cut Nvidia off from a $50 billion market in China. They took a hit in the first quarter, and another $8 billion hit is anticipated in this quarter as well. Now, the other challenge is the slowing revenue growth, but the definition of slow here is just a case of raising the bar too high. 5 out of the last 8 quarters have seen Nvidia report revenue growth in excess of 100%, some in excess of even 200%. And at this price, at this size, anyone will happily take a 70% revenue growth. But such are Nvidia standards that the street is worried that those 100% growth days will never return again. Lastly, sticking to the saluting the rising sun terminology, Wall Street remains bullish on Nvidia despite the surge that it has seen. 68 out of the 78 analysts have a buy recommendation, and the odd one out, a solitary sell rating. That's Nvidia for you. The journey from $1 trillion to $4 trillion has happened in a jiffy. Now the onus lies with Jensen Huang and the company to embark on the next trillion, one chip at a time.
Thank you very much for that. It's quite incredible, right? As you said, when they came out with their numbers, and there was this whole China hit, I think a $2.5 billion hit in Q1, then they said $8 billion loss expected in Q2. Despite that, the stock is up so much, right? From the April lows, it's up about 80-90%. Pretty fantastic the way, Nvidia just goes from strength to strength. Thank you very much for that. Well, that brings us to a close on Trading Up from the entire team. Thank you for watching.